Hello, everyone. Welcome to our healthcare webinar. We are so glad that you're with us today. And as I get my slide here situated, I just want to let everyone know that we've got a really great group of practice administrators and owners here today. Thank you so much for joining us. My name is Teresa Rickard. I'm a part of the practice growth and marketing team here at Jones Roth. And today we're going to be talking about key tax provisions and planning opportunities for medical and dental practices as we approach the end of this calendar year, and considerations for you. Joining us today, we have three of our Jones Roth partners, Nicole McOmber, Brian Newton, and Jeremy Prickel, who serve as the leaders of our firm's healthcare and dental niche team. This is a really great opportunity for you to ask questions. So I encourage you to go to the questions panel, submit your questions at any time. We are going to do our best to answer those as we go along, and then we'll have a short time at the end for Q&A if there are any additional questions. Just a little logistical reminder that we will send out the recording to this webinar as well as the slides on Monday. So if you want to be taking some notes, you are welcome to do that, and you'll be able to watch it again if you need to. Before we get started, I want to do just a quick intro to our firm here at Jones Roth. We are one of the largest CPA firms headquartered in Oregon, and we serve clients across the Pacific Northwest. And our healthcare practice success plan is designed to offer practice owners and administrators like yourselves value throughout the year rather than just at tax time, enabling practice owners to maximize their financial and operational success, as well as the personal success of the owners through an integrated tax, retirement, financial management planning service. I also want to give a quick thank you to our strategic partner and our sponsor of our healthcare webinar series, the law firm Watkinson Laird Rubenstein, who provide a broad range of legal services to healthcare practices. With expert knowledge of the complex regulatory environment, their healthcare attorneys help owners as they navigate the challenges of operating a healthcare practice. So with that, let's go ahead and get started. And Brian, I'll pass things over to you and kick things off.
Thank you, Teresa. Thanks again, everyone, for joining us today. We're excited to chat with you for roughly an hour. Rather than just kind of tell you what our agenda is, I'll tell you what our goal of this webinar is. We really, in the end, want to encourage everyone listening today to please submit us questions as we go along, starting now. We really want to prioritize the questions you may have for us with this opportunity. We do have some questions we created ourselves to make sure we get the ball rolling. And if there's any questions that don't come in, we can still fill your time here for roughly an hour today. But please, submit questions. We want to definitely get those as best we can. And given if we have time left at the end, we'll also have kind of written up for ourselves some key tax planning opportunities or considerations that we have to go to or discuss through, again, assuming we have time to do so, absent questions coming in or otherwise from the group here listening. So we really appreciate your time, and we really hope to make it really beneficial for you. Like any great presentation, we'll start with some fun qualifiers here for you. Information in this presentation has been developed solely by the presenters and does not represent official position of Jones Roth PC. The information herein is deliberately general in nature, is not legal advice, and should be customized and tailored for each situation. So please consult a qualified CPA with any specific facts for you or your business. Nothing here is meant to be a formal recommendation or otherwise. And additive to that, please keep in mind that we're in a very dynamic tax changing world, more likely than not, now and into the near future. So there are also discussion points that'll be presented today that could be different who knows when. So please ask questions, talk with the proper professionals on anything. additive to what you see here written in front of you, in the circumstances with recent news and information. It's more likely than not that some politically driven topics or questions might come up as part of today's discussion. Jones Roth makes no political positions, officially or otherwise, none of the presenters either, but circumstantially there might be some connectivity to political outcomes, political discussion that might result in thoughts as it relates to your tax considerations for you or your business. So please, we also make no representations politically or otherwise.
Okay, well, let's get started with the first part of our session today and dive into key tax provisions. And let's start with this as our first question. Now that the election results are in, what is the new tax law for next year going to look like?
Well, I'll jump in on that one. We're going to just dive right in. This has been a hot topic question through the entire last year, but really since 2018 when we had our last major tax reform come forth. So leading up to this week, we were constantly hearing about what the potential new proposals could be. The media would hit on things, we'd see speculation. You'd probably even ask some of us, and we felt like we were giving the different probable solutions of where we might land. However, even when the Oval Office is filled and we have the new Congress established, as we're still working through tallies and votes there, where the new tax code will land is still in flux. And unfortunately, it's going to be there until it isn't. And many of you have sat with us before. We've talked through this when we have fluid tax provisions. Until the ink is dry on the paper and voted into place, it's going to be very fluid. The elections thus far have given us some clarity so that we can kind of hone in a little bit more where we're headed. For example, a big one in Oregon that was a state driven measure that we were watching closely on tax law was Measure 118, with a large failure there, which gave many of us a great sigh of relief because that was going to be a struggle of how we were going to incorporate and weather through that. But aside from that, there's still a lot of work that needs to be accomplished before we have certainty on what the pending tax law changes will result. What we do know, so we can kind of go through the logistics of what's going to set the stage for us as we kind of roll these out, is that our current tax law that we're functioning under has some significant tax provisions that will be sunsetting at the end of 2025. So if nothing were to happen and Congress didn't have any new laws for us, come January 1st, 2026, we were going to see major tax law regardless, of if other bills were passed or not. So now that we've gotten through election, the question often leads to, so how do we get there? How are we going to get a new tax bill, and how is it driven? While we look to the president to understand what their proposals and initiatives are, it's important to remember that Congress is where bills start when it comes to revenue and tax provisions. All bills for raising revenue originate in the House. But then the Senate has the opportunity to propose or concur with amendments to a bill. So as a tax person, that's really been my hot topic area, is really watching what's going on in the House and the Senate, as well as what's going on in the White House. So as a result, we're watching both very, very closely, because that helps set the stage of what type of leadership and what are the potential bills to come. Although the final count in the Senate is still pending, it is certain that Republicans will control the chamber for the Senate. However, we're still waiting on results on control of the House. But at this point, it's looking like it's very likely that we're going to have a Republican controlled and have a majority in the House as well. If the Republicans maintain control of the House, because they were main control prior to the election, and there was some question of whether or not that was going to flip. But if they do maintain control, we can expect at this point major tax legislation in 2025. We just don't know exactly what it's going to be, but what will likely happen if we have a Republican-controlled Senate, House, and White House, the presidential kind of grouping, is that we'll probably see a lot of language around passing bills potentially through a budget reconciliation procedure. And what that does is it allows a tax bill to be passed with only a simple majority vote in the Senate without being subject to filibusters. Those are terms that we hear float around anytime there's kind of blockage or trying to stop bills from moving. So it would simplify if they can get the votes in the control that they're looking for to support the potential bills going forward. So the important thing to realize with the budget reconciliation is that it has been routinely used by both parties to enact tax legislation when one party controls Congress and the White House. Our two most recent examples, one was 2017 when the Tax and Jobs Act, which is the major provision that we're functioning under at this point in time of tax law that's due to sunset at the end of 2025 was enacted. The last major one that we saw in a budget reconciliation passing was actually the Inflationary Reduction Act of 2022. What happens with a budget reconciliation is it can be used to change mandatory spending, except for Social Security, which is one of the other major tax provisions that people keep talking about. So we know if we see a budget reconciliation act, we're really looking specifically at tax brackets, tax deductions, and whatnot. So as we kind of navigate through that platform, we're going to be looking to see where do we land after, maybe we'll know today, maybe we'll know next week where the control in the House will be. And you're going to start hearing terms like, oh, we have a trifecta if the House maintains to be controlled by the Republicans. But a trifecta, it's really slim because that means they can't really afford to lose votes if they want to push things through in the type of control that we're looking at. So it's a very narrow control. So overarching, we have a flavor of what we can expect to see, what types of funding might be on the table, what leadership thoughts we hear coming around. But throughout the campaign trail, we did not see a formal proposal from Trump on an entire tax policy, but we have heard some flavors, and this week we've already heard some new pieces. And the overarching theme we're seeing in tax bill and legislation that we can anticipate is a central focus around reduction in taxes with a growth strategy, meaning how do we grow the economy in general, grow revenues, because they have to be able to offset cuts in areas with revenue raisers. So part of that would be if there's tax cuts, how do we generate an economy that's going to generate more revenue? If we generate revenue, that generates more tax dollars to balance their budgets. So a couple of things we're looking at and have heard already is let's make the Tax and Jobs Act permanent. Remember, I mentioned before it was passed in a budget reconciliation. When a budget reconciliation, there's strings attached. It's not an unlimited. So we had a limited time constraint and budget that was put together with some of these bills expiring. That same will ring true. So making it permanent could be a challenge. It just depends on how they're going to pay for things. We're hearing a lot of noise around corporate. So you see corporations out there of a potential tax cut. We're currently at a flat tax for federal tax rates for at a C corporation of 21%. Now we're hearing maybe we drop it to 20%. We've also heard maybe it's dropped to 15% for manufacturers that manufacture in the US. A lot of fluidity around there. That's actually one of the tax bills that's not part of the Tax and Jobs Act that was going to expire. So lots of moving pieces. Are we going to see an elimination of the state and local tax deductions, which we'll dive into in a little bit later? That's that good old SALT cap. So all in all, how do we measure if they achieve growth? What are metrics they're looking at as they draft these tax bills? Is there going to be increased economic output? Are we going to see increased business revenues? And with the flavor of reduction in taxes paid over time. So it doesn't tell us with an absolute. So as I mentioned at the start of the question, there's a lot of legwork that's going to have to be done before we know what the, I'll put in air quotes, new tax law will be. It's possible we might see something passed that's effective for 2025. So anything's possible, but it's most likely that we're going to see something passed in 2025 with effective dates of 2026. So stay tuned, stay plugged in with your advisors as we navigate kind of this new platform of change in leadership. But we knew regardless that we were going to have some major changes coming. It's just now we've gotten a little more clarity of where their initiatives are headed.
I have two quick things, Nicole. Number one, you probably could see me and Jeremy looking very tentatively or attentive to Nicole, just so everyone here's aware. Anytime she talks, I learn something new. So, you know, when Nicole's talking, please listen. Number two, it sounds like we're in a unique environment, right? So a key takeaway, I think, for everyone listening is usually our mind goes, if I don't hear anything on taxes, I can expect them to be the same, right? But we're in a unique environment right now based on some sunsetting provisions that Nicole alluded to, that if you hear nothing, that means things are going to change in 2025 from what you've currently experienced for the last several years in broad strokes. So it's really important to have that in your heads, that you might hear nothing or very little, it's possible, but that probably still means, or more likely than not means, you need to change something somewhat quickly of what you're doing or react to a change. Does that make sense, Nicole? Do you agree?
Absolutely. So we have change regardless. We're just hoping we can get in front of it a little bit sooner so you guys can actually incorporate it proactively. Whereas I was concerned if we had a split House and Senate, there was a good chance we weren't going to know until into 2026 with retroactive to the beginning of the year tax changes. So I guess if anything, at least we have a little more clarity that we'll probably get some news sooner so we can actually plan for it and incorporate it into your budgets and planning accordingly.
Great. Thanks for that really great answer. Here's a question for you. I read an article that we're going to lose our 20% income deduction. Can you tell us a little bit about what that means?
Yeah, thank you, Teresa. I'll go ahead and take this one. So as Brian and Nicole were mentioning, we have a lot of these tax laws that have been in place since 2018 that are going to sunset. And one of them is called this Section 199A, that's code speak. But essentially it's referred to as either qualified business income deduction or the 20% deduction. And essentially what this does is allows pass-through business owners, you know, S corps, partnerships, sole proprietors, it allows them to take a deduction equal to 20% of their income in determining their tax liability for the year. So essentially this reduces their effective tax rates by 20%. It's a huge deduction, and it's been enjoyed by pass-through business owners since 2018. So this is a big one that's going to go away. For those of you who have been receiving this deduction, you may know that there are some limitations to it. The first limitation is a wage and qualified property limitation, which reduces the deduction an owner can claim according to the owner's share of business's W-2 wages and the unadjusted basis of its assets. So in other words, if you don't have W-2 wages or you don't have any unadjusted basis in your assets of the company, then there's a limitation in terms of how much you can take of this 20% deduction. There's also, and one that's very relevant to the audience today, is the limitation related to specified services, trade, or business. The IRS basically says service industries like doctors and accountants and attorneys have to calculate this deduction using a little bit different rules than, say, a manufacturer. And so there's a limitation on taxable income. So for instance, if your taxable income, if you're married and your taxable income is over $383,000, sorry, my light just went out. If your income's over $383,900, then your tax deduction starts to get phased out, and is eventually eliminated at $483,000. So some of your owners, or some of you, if you're the individual receiving this deduction, may not have seen this deduction anyways because you may have been phased out of it. But there's a lot of you that probably were receiving this deduction. And as Nicole was talking about earlier, this deduction is temporary and technically will go away at the end of 2025 unless we hear some kind of tax bill that gets passed before then. And this is a huge deduction for a lot of our clients and a lot of you. And my fear is that we've gotten very used to receiving this deduction. So when it goes away, it's going to be a huge tax increase and a huge shock to those that have been receiving it. So it's a huge planning opportunity because, if your doctors or you have been receiving this deduction, you really need to start paying attention to where this is going to head, because you'll have to plan for paying in that 20% increase in taxes should it go away and not be replaced. So Teresa, that's my answer to that question.
Great. Okay, that helps a lot. Here's our next question. Are my state taxes going to remain deductible?
I'll jump in and at least start the tackle of that one. Like many questions, right? It's a fun one. I'm going to start, I think, by breaking apart the question a little bit more to make sure there's proper clarity in the answer. So the opportunity of taking a tax benefit, a tax deduction against your federal taxes for paying state and local taxes, of course, has been a long-standing overall benefit in tax law, so that you're not hopefully double dipping, right? We like to look back and say, oh, I got to pay both. No, you get a deduction, traditionally speaking, for paying state and local level taxes against your federal tax liability. It's also important to kind of understand there's a lot of different potential state and local taxes, right? From a state perspective, you can have income tax, you can have sales tax, you can have some kind of revenue-based tax, right? Oregon as a state applies 2 of those 3 to businesses on an income tax level, as well as a corporate activity tax, possibly on a revenue level for some taxpayers. Then you also can have, more smaller locality taxes, property taxes. Lots of larger metro areas might have some kind of locality tax to individuals through to themselves, individual owners. In broad strokes, any state tax that is paid, or local tax that is paid by a business entity, generally speaking, in most cases, is deductible for federal tax purposes, right? That it holds true. Now, what convolutes this whole situation is in recent tax law changes, semi-recent now, many are probably aware, when it comes to our individual tax reporting and filing, we are limited to a total $10,000 deduction for state and local taxes as an individual taxpayer. So what that means is, if I'm paying taxes individually at any of those levels, absent some other scenarios, I do not get a federal tax deduction over that $10,000 mark, right? Us in Oregon, others in higher income tax states know that gets eaten up pretty quickly through property taxes and income taxes and other things, right? That's a pretty low number. But if your business is paying it instead, I generally speaking will get that federal tax benefit, okay? So right now, the direct answer to the question becomes maybe, and who knows what in the future right now, because similar to other things, right now, there's a sunsetting provision that could be removed, which at face value is a positive change. So right now, under current tax law, this $10,000 limitation goes away on individual tax returns after 2025. So right now, we're sitting in a position of maybe there's actually a benefit to come if tax law doesn't change, in the form of being able to deduct individually more of my individual taxes paid to the state, okay, and local taxpayers, paying authorities. All of that is really challenging to dissect initially, and I understand that in conversation. But what's important to know right now, many probably are aware of this, and if you're not, you need to talk to your CPA about it. Because of that limitation that exists individually, in recent tax years, many high income tax states have allowed for pass-through business entities to do what's called pass-through any elective tax treatment, which shifts the ability to pay on a broad strokes level your state taxes, your state income taxes, through your pass-through business versus having to satisfy those payments individually. It creates a federal tax deduction in most cases by doing that. That provision will also go away absent tax law changes, potentially based on your state, if the SALT limitation also goes away, the $10,000 cap. In other words, Oregon is an example. Some aren't this way, so you have to look into this. Oregon is an example. Our ability to do PTEE system payments will automatically go away if the $10,000 limitation does end up going away, because to some extent, there's no purpose in having it anymore. So it's really important to know how this unfolds now and in the near term for planning purposes based on new news, recent news when it comes about. What I want you to walk away with on this is make sure it's an active conversation with your tax professionals and be aware of it, because it will be very important pretty much no matter what. For anyone that's in a high income tax state and has a pass-through business entity, it's going to be an important conversation with very limited exclusions within the next year. An example, just to give you kind of like administrative examples that would be big time, oh shoot, we missed this and there's a big tax surprise potential to our physician owners. If the scenario unfolds that the SALT limitation goes away and or the ability to do PTE payments that we've done now for the last 3, and it'll be 4 years a year from now, if those things go away, all of a sudden what that means functionally is our pass-through owners of our businesses will have to start paying state estimated tax payments again that they haven't necessarily been needing to even think about or pay in a lot of cases over the last 3 and going on 4 years. So long story short, if we're not doing something about this, even if it doesn't improve our tax situation, we could have owners with very big surprising tax bills if they're not anticipating ready to make that shift back to paying state taxes personally again versus letting the business pay it for them. So really, really important.
A lot of complexities on that one, Brian, and I'm one in the camp that I actually wouldn't mind having a SALT cap in order to keep that business level deduction. I just would love to see the SALT cap increase. The way Oregon wrote their law was if the SALT limit, the SALT stands for state and local tax limit on individuals, is repealed or removed, then Oregon's pass-through entity election that we're seeing at the practice level also expires. And so there's a lot of other planning pieces. We could kind of geek out on the tax nuances there. But this is one we're going to be watching really, really carefully as we see what happens at the federal level.
And for what it's worth, I just add that at one point in the last 4 years, there was a proposal on the table to move that $10,000 cap to $80,000, which of course would change things quite a bit. So that's just one thing that was on the table at one point, not an indicator of what will happen in the future, but just something that was on the table at one point.
Great. Lots of lots of details to just be paying attention to see how things shake out. Okay, let's go on to our next question. Are tax changes going to impact how I write off equipment purchases?
That's an excellent question, and it really, as many of you've seen and navigated this with the years, it used to feel like early in my career that depreciation and how we wrote off equipment never really changed. Well, I'd say in the last 15 years, it's been changing and very fluid the entire time, and there's some very strategic positioning and nuances to incorporate when you're looking at equipment purchases and what's the net after-tax effect of the said purchase for your practice. Most often the question I get is, okay, if I buy this equipment, how fast can I write it off? While there's other reasons why you may or may or may not want to accelerate it and have it all written off in 1 year, because that's a bigger picture question. Our tax law is written in a way that we are written in a way that it's accelerated depreciation, which means it's a very fast upfront deduction by default. But the last several years, we've had a couple of provisions that have been available to us to where we could write it all off in 1 year or partially write off, and then we let the rest of it. So for equipment, for example, whatever we don't write off in year 1 comes up to us in deductions in the form of over the next 5 years. Based off of current law, we still have accelerated depreciation options. One of the big ones has been around a long time, but the limits change along the way, is what we call Section 179, or just expensing of the equipment. Another term we've heard thrown around a lot was bonus depreciation. Bonus depreciation has been around and kicked around, has been used as a tool for kind of stimulating economies when the economy wasn't as strong, because they wanted to promote businesses to buy equipment and get a really fast write-off regardless of what your income is. And so that's why 179 versus bonus, there's different reasons we use each of those tools. For the last couple of years, those of you working with us have heard us talk about the bonus isn't as plush as what it used to be, because it was 100% bonus depreciation. But part of that Tax and Jobs Act bill, so TCJ that we keep talking about, this was one of those provisions that was in there with some sunsetting provisions as well. It started at 100%, but has been declining by 20% each year. So in 2024, we're now down to a 60% bonus depreciation. And if nothing gets passed in 2025, we're going to be down to a 40% bonus depreciation. There's some really key interplays with other tax provisions of how to optimize tax efficiencies. And so we actually might choose 179 over bonus for other reasons, but knowing that those two factors are there, but the bonus is on that kind of sunsetting sliding provision is important to note. So there's income limitation considerations with 179 that aren't there for bonus. But I'd say one of my biggest ones that I look at when I'm working with clients is the interplay with these Oregon PTE, the state tax deductions, and how that's calculated at the practice level has really been a prime driver of which of those tools actually made the most sense. The other piece is when we're in changing tax brackets. Let's say we didn't have a great year this year and we have a big piece of equipment that we've purchased. We're like, you know, next year we expect to be in a 10% higher bracket. Maybe I'd rather save those deductions for future years. So just know, just because we can accelerate and take all of it in 1 year, it's not a one size fits all for every practice when they're looking at how to purchase and deduct equipment. I'd say the most important thing is we're at year end and we get this question all the time. And if you're trying to be strategic, you're looking, I always remind people, we don't buy equipment just for the sake of a deduction. Because if we didn't need it, it's not a dollar for a reduction against tax, it's dollar for dollar deduction against income, which then we apply a tax rate. But the most common is we say, okay, well, we bought this piece of equipment, we paid for it, but it's not going to be here until January. Well, if you want that deduction, you need to be a little strategic on it. If you want the deduction in 2024, it's really important that it's placed in service. So if it's not even on site, let alone hasn't been able to be plugged in yet, we're not going to get that deduction in 2024, even if you paid for it, because it needs to be placed in service. So a couple pieces there, not only how do we write it off, what's the timing? If you guys are talking to, if you're having flooring put in or needing, some improvements done, I would really be pushing on your buy wins with the folks you're working with to make sure that it's landing in the tax year that you intended it to land in. Not the end of the world if it falls into January. Life happens. We adapt and pivot, but just want that to be on your radar as you're planning and kind of hitting home stretch as we close the year. So in short, the answer is yes. Tax changes are impacting how we write off equipment, but it's possible for more changes to still come. There's discussions of let's bring bonus depreciation back up to a higher percentage as part of the negotiations. There's a lot of things to come in that provision, but what we know right now is we still have some great tools for how we write it off. It's just making sure it's strategic and intentional to meet your practice needs.
I think what's important for me Nicole, that's, you spoke to, that's kind of my additive to this question is, I think many taxpayers, right, hear a lot, oh, they know about 179, maybe not so much bonus, right, but they're aware of these techniques to take depreciation more quickly. So it's kind of built into us at this point to have the automatic assumption of, because we're told it to some extent in a lot of common discussion, you got to write off as much as you can all in year one at the beginning, right? Don't approach it that way. Nicole spoke to reasons why, changing tax rates, bigger years, smaller years. But another factor there too that I think oftentimes isn't discussed openly before making a decision, because right, once you make the decision on a tax filing year, you either can't or it's challenging to change your mind, afterwards. And so sometimes you got to forecast forward. There's a big consideration oftentimes too on whether you're financing a big equipment purchase or just buying in cash, because it's a great reminder always, because it's easy to follow our cash and get an idea of our tax obligation, right? Our inherent thought is, how much dollars did I make? That's got to be closely tied to my taxable income, right? That's not how it works. Right. Partly and mostly usually because of financing. So if I buy a $200,000 piece of equipment and I'm going to finance it over 10 years and I deduct $200,000 in year one, it might be the right decision. It might feel great. It will probably feel great from a tax perspective in year one. But you have to remember, I didn't spend the $200,000, so my tax feels low. 9 years, for the next 9 years to 10 years thereafter, it reverses itself, and I'm going to feel a tax detriment compared to my net tax-free cash flow, right? So it's really important to understand the long-term, especially when financing is involved, impact of that decision-making, because if things like that aggregate over time, it can become a real problem, because it's easy to forget the past and just remember right now and go, why the heck am I paying so much taxes? I don't have the money. It's because you don't deduct those principal payments on your loan. You took all that benefit in year one. Yeah. So it will be a challenge potentially for a longer period of time. So please, please, please have a dialogue. Consider, especially when financing involves even more strongly the technique we use or you would use on depreciation.
Right. Jeremy hit on a deduction 199A earlier. I call that a phantom deduction, right? You didn't have to spend anything to get it. You just had to meet the eligibility. What Brian just described is where I hear people saying, where's this taxable income? It feels like phantom income just appeared, because you're like, my cash position's not any different this year. Why am I paying more in taxes? Because your money's going towards servicing something you already wrote off. And especially when you have ownership changes, it's a key factor to kind of incorporate and play in there as well. So yeah, it's a very, oftentimes we see these great deals on financing. The last year or two haven't been as great, but we're starting to see rates coming back down. So financing of equipment purchases and the facility needs is definitely bubbling up more as we're going into next year, and being intentional with that is really important. Because you want to be able to say, remember when we had this conversation, and we're going to revisit it. But if people are caught off completely on guard and you didn't see it coming, it can feel very blindsiding.
That's so great. I'm taking notes. I don't know about anybody else, but this is great. This is great information. All right, let's go to our last question, and then we'll transition to the next part of our session. How about tax rate? Is my tax rate going up or down?
Good question. I'll go ahead and take that. The Tax Cuts and Jobs Act, and Nicole mentioned this earlier, as it relates to C corporations, it did lower the corporate tax rate from for service-based corporations from 35% to 21%. And it's important to note that this is one of the few changes in the Tax Cuts and Jobs Act that wasn't temporary. This is a permanent change, which means that 21% tax rate should be enjoyed into the future, and there's nothing you really need to worry about if you're a C Corp. However, as Nicole mentioned, we do anticipate that rate may come down. There is some talk of that coming down further. We'll see if that actually ends up happening or not. As it relates to individuals, this is kind of a big topic, the Tax Cuts and Jobs Act retained essentially the 7-bracket structure for individual income taxes. There's essentially 7 different brackets within the system. And what happened when that TCJA was passed is they essentially lowered each of those brackets and also lengthened the width of the bracket. In other words, the amount of income that falls within each one of those brackets. So if the TCJA expires, what we will see automatically in 2026 is an automatic increase in those tax rates. And also the width of those brackets goes back to the pre-2018 brackets. So for instance, the first bracket, which is 10%, that one is the only one that wouldn't change. That stays at 10%. The second bracket there would be the 12% bracket, which would go to 15%. That's a 3% increase. The third bracket would go from 22% to 25%. The fourth bracket would go from 24 to 28%, which is a 4% increase. The fifth bracket goes from 32 to 33. And then the 35% bracket would not change, although the width within that bracket would change. And then the seventh bracket, which is the one that you hear a lot about, especially with doctors, is the 37% bracket would be going to the 39.6 bracket. So when you hear your doctors talking about being taxed in that 50% bracket, what they're referring to is essentially a 40% maximum bracket for federal. And then of course, if you're in Oregon, you have the 10% state tax. So you get to 50% really easily. So again, the takeaway here is, if nothing happens, all of our tax rates are going up. And that's something to be careful about, especially when you're talking about timing deductions and when when you want to buy equipment, when you want to deduct it. It's going to be really important to look at these tax rates. So Teresa, that's really all I had to say on this one.
I think too, it's really important to realize, right? If you read a question like this, what we know now is tax rates are scheduled to go up, but what you effectively pay in taxes impacted by so many things, right? So it's really important that as we're going through this changing dynamic to be actively understanding of how those dynamics are going to interplay, because in a scenario where we get to keep our 199A deduction and we get to keep utilizing the benefit of PTE, but also the scheduled tax marginal rates go up, that is very different. Is my taxes going up a smaller delta than an alternative of PTE opportunity goes away, 199A deduction goes away, and tax rates do end up increasing, even though the tax rates didn't necessarily change differently in those two scenarios. Your total tax, and therefore what you will feel for a tax rate, will go up more so in that environment. So I think the important part is being aware and having those discussions as we learn more and more new information of what we're going to see change or not change from current tax law.
And I think don't just follow headlines is an important reminder. Individual circumstances, even if you hear an overarching, I said at the beginning that the current administration coming in is saying, we're a growth strategy with a tax cut. It doesn't mean everyone will see the same tax cut, let alone that everyone will even see a tax cut. You might stay the same, you might go up. There's a lot of moving variables. And so really trying to be specific and running your own forecast based off of the multitude of variables is really important. If you hear those questions or the headlines, I always tell my clients that, hey, as we're working with you, if you hear something like that, it's keeping you up at night or you don't know how it impacts you, that's what we're here for, is to help you navigate through those, because you're gonna hear a lot of noise in the coming year as we work through and see what tax bill comes out.
That's so great. We have a question that's come in from one of our audience members here. they're considering selling their practice. And so with these anticipated changes in tax law, what would be the key factors that they need to be considering in terms of selling?
I'm happy to start with an initial response on that. And honestly, more on a backwards basis. This is a topic we, of course, have to be a little bit careful about being super specific on, but frequently assuming if you have a pass-through entity that you're, have as your example, it's really important. We've kind of talked about the history now of PTE a little bit and other taxes off the cuff from a backwards perspective during that potential process. Make sure you're considering those additional taxes, because historically speaking, when you talk about a potential business sale, you add back taxes, but oftentimes as a pass-through entity, that's a small number, so it can kind of be ignored for trying to figure out a fair value. So pay attention to make sure you're incorporating your tax situation, because that can deflate your reported numbers at face value if you have the PTE program from what most would argue is a better, net income multiple, things like that. So please, all this changing dynamic has a potential substantial backwards effect of how the evaluation of business value might be done, is what I'm essentially trying to show.
I actually have several transactions I've been working alongside with buyers and sellers in the last, this last quarter has been a very heavy month. And part of it's just that some having fears of, will tax rates be going up or down? And I know that yesterday, one of the transactions we're working through, we felt like we were in fire drill mode to try to get it done by the end of December. And given the transition and what we're hearing on noise, all parties feel a little more comfortable that if this goes into 2025, there's less concern that there's going to be an increase in rates in 2025. It's not impossible. So I always remind folks, as you're navigating. But this year, I'd say one of the big ones that came up really often was as people were getting closer to negotiating a deal, and if it looked like tax rates were going to be a factor in there, started hearing more and more conversations about trying to say, hey, if this doesn't close on time and now it's kicked into a year with more of a tax rate, we want a true up provision on the table. And how does that impact things along there? I'd say coupled that with whether or not you're going to sell on an installment note. Maybe you end up carrying some of the note yourself. Do you really want to be collecting this tax over 5 years or 3 years, or do you want it all up front? I could tell you, we at least have a little more visibility with that. There's a good chance we'll know before we get to the end of 2025 where we're going to be in 2026. So you have time to make some of those decisions, but I'd say the main tone and pulse that we're getting is there's less of a stress of, hey, did I put myself in a bad situation by not closing this year versus next year? And overall, so far, it doesn't look like there's going to be a harm factor to have to budget for. But often, there's ways to address some of those in how you write your contracts. But I'd say ultimately, there's a lot more that goes into it than just knowing what your tax rate is, how you structure the deal, what types of allocations you use can drastically change. So make sure you're working closely with your tax and CPA advisors as well as the attorney team as they navigate, because one word can change significantly the tax impact of the transaction without you realizing that one word changed it.
That's great. Well, let's shift now to some of the tax tips and the opportunities that are out there to consider. Let's start with reviewing retirement plans and contribution goals.
Yeah, so one of the...
Jeremy, sorry to interrupt. Before you jump in, maybe we'll do a quick, we got 11 minutes left. So if anyone has any questions and they're hesitant to ask them or anything like that, now's the time. Otherwise, we're going to kind of go through some of these things. But if someone throws in a question, we're going to still try to address those in between, because we'd like to feel those as the first priority.
Sure.
Excellent.
So if we don't, Teresa, if we don't see any now, which I don't see any, I will go ahead and just briefly talk about this topic, which is, every time I get to this stage in the year, I always talk to my doctor clients about making sure, or any client, that we're making sure that we're maximizing all of our deferrals into our 401ks and retirement plans, whether that's 401k, 403b, 457. We want to really try and max out those limits. But I also thought I would just mention while I'm on it to talk about the limits and what they're changing to for 2025, because it's also a good opportunity to look at their pay stubs and adjust those going into 2025 so they reach that cap. And there are some notable changes. The elective deferrals for 401ks and 403bs, that limit is 23,000. It's going to 23,500 in 2025. There's also catch-up contributions for those plans. That catch-up is $7,500 for 2024. It also remains at $7,500 for 2025. The IRA contribution limit is $7,000 for traditional IRAs and Roth IRAs. That limit is not changing in 2025. The other major change that happened is there's a new catch-up contribution for 401ks for people that are between 60 and 63. So 60, 61, 62, and 63. If you're in a 401k, you can actually put in an additional $11,250 in 2025. This is one that's going to shock a lot of people going into 2025, so it's a good one to talk about now, so you can start deferring more money in 2025. I think for those of you who are handling payroll and items for your doctors, if you can catch this one, it'll be a big one, big feather in your cap to have that being coming out of the payroll throughout the year rather than remembering it at year end at the end of 2025. I'll go ahead and I think Nicole, you're going to talk about this next one.
Yeah, this next one's always a hot topic one for me because I do not like asking later after the tax year's closed, did you do all this? And then you didn't, and then your CPA says, well, now you got to go amend it because we have a problem, right? So I always say reviewing W-2 reporting items as you approach year end, the 4 that really stand out to me, before you run that last payroll, because also I'm very cognizant of that most payroll providers are going to charge you extra if you have to do an extra payroll run as well. So as you're approaching, last payroll runs in December, but I'd start now because if there's multiple things going on, it's easier to kind of incorporate and work them in. One, if you're an S corporation, make sure you're correctly reporting and capturing premiums for health insurance that are paid for the owners by the practice in their W-2. It's a logistical piece. They still get a deduction for it, but if it doesn't happen, it's not a deduction, and it's actually very problematic. So it's a big one to, especially with the cost of health insurance premiums, a big one to make sure if you're an S corp that step has occurred. The second one is vehicles. If your practice owns vehicles, whether it's vehicles that are being driven by non-owners and or owners that are employees using that business vehicle, it's really important to review and make sure you've captured any personal use of the vehicle and capture that on the W-2 before the end of the year. There's formulas to follow and kind of work through. The important thing is having total miles on the vehicle for the year and then how many of those are personal. And I get the question more often than not is people thinking, oh, but they're just driving from home to the clinic, so that's all business. Well, home to the clinic is generally going to be speaking personal. That's your commuting time. There are provisions and things to incorporate for call pay and whatnot, but just know, hey, visit that one. It's a hot topic one that if you're ever under examination, whether it's the state or the federal government, it's always looked at. Third one, Jeremy hit on, review those retirement deferrals. This is your last opportunities. If there's no more pay to pay, it's hard to do any more contributions if you miss the boat a little bit. But maybe for your situation, not maximizing was intentional, but we'd rather make sure it was intentional and not just overlooking it. And the last one, look at those federal and state withholdings. Underpayment penalties if you don't have enough tax paid in. The interest rate, for example, the Fed interest rate, the 8%. that's a really expensive loan if you could have just tweaked things a little bit differently. So I love it when I have the opportunity to do it through withholdings. Because the federal government and the state government look at withholdings as are received equally throughout the entire year, regardless of when they happened. So some of y'all have probably had the situation when you worked with one of us and we're like, oh, it looks like you're gonna have a net zero check because we need it all to go to withholdings this month in order to have enough paid in so you're not underpaid, because those penalties and interest have just gotten too steep. I have very few that are comfortable at this point saying, oh, it's just a cheap loan, because it's not a cheap loan. So good one, a reminder, if you're paying your quarterlies, that's one provision. But the thing I love about withholdings, I don't care that it happened in December. It's treated as if it happened equally throughout the year.
Okay,
Okay,
I'll be
great.
pretty quick on this next one. So making necessary estimated SALT payments. So again, that SALT acronym stands for state and local taxes. We spoke about that a bit earlier. Generally speaking, in most cases, hopefully a lot of that will be deductible for federal tax purposes and usually deductible when paid. So especially with the addition, if you have passed through any elective tax to any state, that makes this consideration and timing of it potentially more important. And making sure you're looking at that before the year end to try to appropriately estimate, and assuming you determine you're best to take a deduction now, you're making those final 2024 applicable payments on or before December 31st of 2024. Otherwise, it's deductible next year, right? Because in most cases, we have till January 15th or sometime in January to make these types of payments. And in most cases, if it's paid in January, you're going to deduct it for 2025 instead of 2024. And with the PTE, it can be a much bigger number. And so therefore, it can have a more substantial impact than we've traditionally seen in a lot of cases to your federal tax obligation from year to year. So
yeah, and then that next one, that next one is just the typical trying to pay expenses before year end if you want to lower your taxable income and lower your tax bracket. Also for C corporations have a double tax system. So if you leave money in them at the end of the year, you're going to pay a corporate tax as well as an individual tax when you distribute that profit. So what a lot of C Corps do is they try to pay out everything prior to year end. So make sure you're looking at your income right before December 31st and get that taxable income out of the C corporation. And then we talked about this earlier, but if you need equipment, consider whether or not you should purchase that now or whether you should wait until next year. Maybe the tax bracket's going to change or something like that. So.
And then we'll just hit quick on one last one. And these are far from the last of the tips that you should consider. So we do have other resources and advise you to incorporate those. But office buildings. So if you have done a full-scale renovation, you bought a building or had a building constructed, there's a study that you can incorporate, what's called a cost segregation study, that can help accelerate and break down the cost of that building and those renovations so that you can depreciate them more quickly. Big picture, a building, if we don't break it down smaller in depreciation, we're looking at depreciation at over 39 years, which very few of y'all are paying it over 39 years. So usually we want to find a way to accelerate. So there's a great tool to incorporate, and it does not have to be only on projects in the current year. So maybe you had a building a year or two ago that you didn't capture this. There's provisions that allow us to do some catch up and make it whole on those projects.
Let's see, do we have time to touch on this one?
We wouldn't have time to get into this in detail, but it's worth, since we have a minute or whatever, that just read this slide when you get it. Know that the Secure 2.0 Act actually has made changes, is making changes now. It's making changes for 2025 and into 2026, mostly around employee retirement plan benefits and provisions. And there are some substantial changes, again, some of which are about to start, even more so in 2026. So for purposes of today and the verbal conversation, if you don't know what this is, start looking at it, reach out to your professionals and talk about it, because it's happening now. And it's important on some of them to be aware of it because it's some required stuff.
That's great. And like was just hinted at, everyone who's registered for the webinar should have received an email from us at Jones Roth with tax tips which is a resource that we publish each year. And a lot of what was talked about today is you can find on that worksheet along with other issues and topics. So look for that in your inbox, and then look for an email from us on Monday with the recording and the slides. Of course, as always, reach out to us. You can go to our website and connect with an advisor if you want to explore working with us or have questions about your own practice. We thank you so much for joining us. Thanks to our 3 panelists today. Thanks for taking the time. And we'll see you at the next webinar, everyone. Have a great weekend.
Thank you.
Thank you, everyone.